What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is December 15th of 2018. Well, folks, I hope you all are having a wonderful day wherever you are. And today on the Daily Update, we've got a few key topics to really discuss. I not only want to spend some time talking about what I'm currently watching for in regards to Bitcoin's price and what are going to be my actions if certain things happen in the market, but along with that as well, I want to spend a lengthy amount of time to talk about a question that I've been getting asked from a lot of people over the past few months, and that is whether or not we are repeating history, and more specifically, if we're repeating the same steps that led us to one of the greatest financial crises in history, what happened in 2008. Now, I want to spend some time, as you all probably know, emphasizing that I do believe there is a recession around the corner, but I also want to mention as well and be fair in the sense that this is a little bit different than 2008 and spend some time bringing up some of the key points that make it different than 2008. So we've got lots of things to discuss, guys. We're going to be going through lots of data points. It's going to be an exciting one. Hope you can stick around. Let's jump right in to the daily update. Today's sponsor is Interdax, a Wall Street-grade derivatives exchange built by ex-NASDAQ and New York Stock Exchange employees. Interdax will offer up to 100 times leveraged perpetual swap contracts with the underlying coin as collateral. Interdax is one of the fastest exchanges in both the crypto and financial industry, built from scratch with sophisticated C++ and KDBQ technology. Interdax will be able to handle up to 300,000 transactions per second, meaning you can say goodbye to system overload issues. In addition to this, they plan to revolutionize trading as a whole with their unique idea of trading battles. Participants all start with an equal balance with a goal to turn their trading stack into more than their opponent before the battle ends. Interdax is currently holding its launch contest with one of the largest crypto giveaways to date, with over 100,000 in prizes including Bitcoin and IDAX tokens. Details and rules can be found on the launch contest page. Simply sign up with your email, get your referral link, and share. Points are accumulated by referral signups and social media follows and shares. First prize is 10 Bitcoin and over 1 million IDAX tokens. All right, so let's go ahead and take a look over the market here. As you guys can probably tell, because Bitcoin is down a little bit over the past 24 hours, markets are mostly unchanged, if not a little bit in the red. However, I did notice over the past 24 hours that we do have some of the larger established players up in the green. For example, I'm noticing with a pair of volume as well, Waves, Hypercash, Litecoin, Digibyte, and Stratus, as well as IOTA, Tesochain, and Quarkchain, and EOS doing quite nicely in this market. And again, you want to see not only good price gains in the red, but you also want to see matching volume with it. And I have no doubt that, again, in these markets, guys, you got to deduct a little bit for market makers and some of these exchanges that aren't reporting true volume. But I can tell you for Litecoin, it is good to see that, that kind of representation of volume for its market cap here. And even if there was a little bit deducted, it's still quite impressive to see that in this bear market. And we have officially come back down to a level that we were talking about in the previous few daily updates. We've come down this far, guys. It was pretty clear that, again, we're going to be hitting $100 billion. And then also as well, as Bitcoin starts to continue going down, it's looking like it's going to test the big even on most exchanges of 3,000. We're only about 100, I think $80 or $200 away. Really depends on what exchange you're looking at, but I use Coinbase on a lot of the major retail exchanges in that case because you don't have the premium of Bitfinex. I know I keep talking about that. Just want to make sure that people know there is a distinction between the rates that you're getting on different exchanges. But going on, Bitcoin dominance not changed too much in this case as altcoins are holding relatively strong. As we start to approach this level, guys, there's really two ways to play this here, at least in my opinion. We can see clearly here that there was a line of resistance holding down price here on Bitcoin, and we have yet to escape above that level. And we don't even really need to use the moving averages at the moment. They're quite still extended to the highs up here, where price started to dip off here from the 6K support that was holding for the past few months. The two ways that I'm really playing this here is, as you all know, I have some long-term positions in crypto I'm not touching, but in regards to additional positions and potentially looking for a change in reversal, there's really two ways to play this. I have no doubt that this could still go lower, which is why I'm remaining patient. I'm waiting for the test on the big even. I think a lot of people are waiting for that, and it's going to be a matter of whether or not we get a lot of volume coming in, holding support at 3,000, and I'm not only going to get bullish when I see that. I need to see something else. I need to see a break on this line of resistance because when we get that, the next objective from there is to make this support, or at least to hold above this line of resistance for a while, and then start to test some of these moving averages. And now, for example, I talked a little bit in our newsletter and webinar session about some of the key targets that I'm looking for, but it usually has to do with playing a little bit of tango with these moving averages, coming back after a dramatic sell-off like this. Because again, we've had more than a 50% correction from that key level of support that was being held at 6,000. If we come down specifically to touch 3,000 in this case. So I think we're very much going to test that level, no matter if we break below in that case. And again, in the worst case scenario, if it goes down and breaks through 3,000, I not only have my long-term position, but I'm going to remain patient. I'm going to wait for a serious level of capitulation to come in after a break on 3,000 if that comes through. And if that does come through, I'll keep you guys up to date. We'll do a live stream, things of that sort. But I think it's very possible that we could hold here. Okay, I'm just saying, it's 50-50 here. I'm waiting for a trend confirmation because I'm not going to add any more from the exposure I already have until we see a real trend reversal. I want to see it break past this line of resistance, or I'm going to be buying on a really, really cheap dip where I start to see the market rebounding and price picking up with volume. So that's the general gist for cryptocurrency markets, guys. Again, nothing changing too much. Volatility is quite low at the moment across, as we can see here on the Coin Paprika Index, volatility is quite low. A lot of the sell side has been realized over the past few weeks, and now it's a matter of just testing a key level and finding where the markets are going to get this bottom. But in the longer term trend, I want to share this with you guys. I think we're going to be tossing around this range for a while before we really get any serious pickup in the market. So there could be some good trading opportunities in between here. So we'll keep an eye out for that, and I'll be sure to share anything I come to realize over the next few weeks. Going on here, though, I want to spend some time to talk about financial markets, and not so much to look at individual stocks or equities, and not even really looking at commodities this time around. I want to spend some time this weekend while things are quiet, markets are closed, to really do some fundamental research and to get a grasp as to where we are in regards to the macro trends of equity, not so much equities, but specifically asset markets, and predominantly in financials and housing. This right here is an ETF. It follows an index that is what's known as the S&P 500 financials. It's a conglomerate index that measures the current status of the financials in the S&P 500. A really good basket of all the major banks and financial creditors and institutions. And again, I'm on the ETF here, guys, but if you want to look at the index, it literally tracks the exact same. I don't think it's really changed since then because the chart looks the exact same. But you guys are welcome to use the index as well. I'm just looking at the ETF here. Now we can see here, there's a very key thing to focus in on, and I'm going to give you guys a second. And you probably might have noticed it off the bat and really know about my point here because I have mentioned this chart once or twice on the channel. But what's the major thing that you notice here if you take a look at this chart? So we have, for example, our timeline down here, and we've got our price range on the ETF here, or predominantly on the index. What's the thing that you notice? Well, the thing that I noticed specifically right away, and this was actually the month that we actually hit serious resistance on. It was back during the earlier part of 2018, and that is right here in January and February more specifically, the resistance that we hit in 2007 at the peak of the bubble, which led into the 2008 recession. This is 10 years after 2008, guys, and to see the financials as a whole, it would be one thing if a few banks were topping out at this region, but as the financials as a whole have come to the same price range and valuation range that they were back during 2007, and to see such sharp resistance and to see price now actually over this month having a really bloody month, it is very concerning to me. Now, a lot of people, for example, are under the impression, because I think a lot of people got interested in financial markets since 2008. They have seen movies like The Big Short and all these kind of things that get people very interested in. It's crazy how these big bubbles can be blown up, and the recession and the crash can actually be just quite interesting to learn about, and how we got in this mess. And I love studying financial markets, guys. But the thing that I want to answer here today is, where are we currently, and is it like 2008? I think I'm going to summarize my message here, but I want you guys, if you're interested, to stick around because there's a lot of interesting data we're going to look at, and I want to make sure I back up my claims here. I think we're in a situation where we are setting up for a clear recession. We are well overdue. Recessions tend to happen every 6 to 8 years, and we are 10 years from the last recession in 2008. Not to mention as well, we have made a lot of the repeated mistakes that leave us into every bubble. This is just something that's historically true. It usually happens to be with lowering of interest rates, easing of the economy, whether it be quantitative easing or regulatory policies that help to uplift the economy. But I want to spend some time as well in regards to terminology like regulatory policy, that this isn't exactly like 2008. And I know a lot of people would disagree with that. They believe that we're going to have the same sharp correction. It's going to be exactly like we saw back here. But I want to spend some time to talk about how we're in a little bit of a different position this time around. So again, nice neutral view. As you all know, I'm quite neutral. I don't view things in a black and white nature. But I better stop rambling at this point and get into the data. So as we can see here, obviously the financials here have topped out. We'll take a look back at the chart here in a little bit in regards to look at the home builders to continue talking about this. So the first thing that I think a lot of people start to focus on when we talk about the housing market has to do with some of the major cities across the United States, and not just in the United States, but in major cities across the world like London, for example, Shanghai and Hong Kong, and Sydney, Australia, and Melbourne. I focus on global markets in a variety of different countries, and also Canada as well, and Toronto, and a lot of the major areas where you started to see these big real estate bubbles in the cities, where properties are going past $1 million for a normal condo, really ridiculous levels. So a lot of people see this and, see some of the sharp declines. As we've seen steady rises in 2016 and 2017, we've also started to see sharp declines where it looks like there's a trend reversal. The important thing to take away with some of these city properties, and I think it's really the first topic we should talk about, is that most of these cities, guys, have really been propped up by real estate investors. So these aren't people, for example, going out and getting a mortgage, for example. These are people buying up properties, aiming to make money, A, through the property going up, and B, also through potentially renting the property. A lot of people who can't afford to go out and take a mortgage in the city, not to mention they don't know if their job might be in that city, if they're going to be staying there for the next 30 years, tend to have to rent. And there's been a really big issue where there's been a massive amount of centralization from investment managers into real estate properties, and now a lot of home ownership is not as common in the United States. If you take a look at the statistics, we're nowhere near levels we've seen in the previous years of history, and it's been declining actually over the past few decades. But a big part of that plays into this fact that there's been investment banks, investment managers who have been going through and buying up properties, entire companies that just simply go out and buy properties and invest in them and hopefully turn a profit and be able to flip them. But in this case, they've got overly confident and they've gotten overexposed. And we can see here that especially in areas like Manhattan and Brooklyn, we're seeing double-digit drops every single quarter. So I think you're going to continue to see this. I think, over the next few quarters going into 2019, this could pick up and we'd get back much more to reasonable levels in regards to the cities. But I don't think this is the overall housing market because housing in general, in regards to outside of the cities, has not risen like it did back in 2008 levels. I'm talking about normal standard real estate. I'm not talking about this massive city-based commercial real estate like condos and condominiums and stuff. But I want to talk about more than anything, okay, I'm rambling here, in regards to the general real estate market, that we are seeing a slowdown. We are clearly seeing mortgage rates go down, mortgage applications go down, home sales of pending homes and new homes declining, but it's not happening at the sharp rate of what we saw back a few years ago, back during, for example, going into the latter of, the bubble here in 2007 and continuing to 2008 and 2009, as well as some of the declines we even saw in 2011 and here in 2014. So let's go ahead towards the shorter time frame here. We'll actually go down to the yearly here. We can see we have had, obviously, in 2018, a complete decline in pending home sales. And what this basically means is homes that have already been built, someone has lived in them for some time, as you can see previously on U.S. homes. And we just had a major month in October slumping down in these home sales. And I can tell you guys, we felt it. We live in an obvious home that is not new. But basically from here on, we actually had to take our house off the market. This has been something that a lot of people are having to do because people aren't buying older properties that sometimes actually are more expensive than the new ones. A lot of millennials have to be very cost effective when they're raising their first family, and they're buying homes that are somewhere between 250,000 to 300,000 to 400,000, and many of them are nice homes, and they provide what millennials really want. In some cases, millennials live very simple lives and don't need as much square footage as traditional homes have, or some of the features that they might have. So because of that, pending home sales have been on a clear trend shift here. And again, we're entering in one of these cycles where for a while, I think it could last like this. I think that there's not much demand. There's an oversaturation of homes in regards to a lot of the new homes being built. So they're selling out like crazy where I live, and we don't see a lot of the older homes getting bought out because they're just too expensive. So until we see a major drop in prices, until we see rates more favorable, this is going to continue, but it's not going to be sharp as we've actually seen even here between 2014. I think it's going to be a slower decline over a longer period of time, a grind in the housing market, as we're not having these sharp upswings and downswings. Going on here as well, even new homes are not in a safe position. They've actually started to see a trend shift here. Now we've seen actually, if we take a look, this is historic data all back through the 60s as well, that it tends to be that, in regards to, again, this is at a rate of thousands as well. So in October, for example, we had 544,000 in regards to the seasonally adjusted rate here of purchases of new homes. And we can see here that it tends to be that outside of excluding the crazy bubble we had during the latter of the what led up to the bubble and the recession in 2008, we could see here where we were getting about 1,200. We usually top out at around 800,000 in this case, usually for most of the cycles between the 60s to the 90s. And this time around, what's very interesting is that we haven't even been able to get up to the mark of 800 in this case. We actually topped out more around the upper 600 to $700 or 700,000 range. And we're already starting to see a clear trend shift here. This is not a simple short-term correction. This is looking like we're starting to see a little bit of a shift here, even in new home sales. Now, why is this? Why are we starting to see this even in the new home sales, which have been kind of the leader in this market for real estate? Well, it's because of one single factor, and that is mortgage rates going up. So the base rate in the United States, the Fed funds rate, which is what the central bank charges in order to borrow capital, is going up. And with that, you will have mortgage rates go up. You will have rates go up on taking out money borrowing credit in regards for a credit card, for a car loan, for student loans. All of these rates bump up at a time where, again, we're just finally starting to get wage increases in the United States. And not to mention as well, we really, in my opinion, I don't think we've seen an economic recovery, not for the middle class, not for the poor in this country. That's just been something that's not just true over the past few years, really over the past few decades. There has really been a divergence in the United States and across the world in that case. And it makes big assets, for example, like this, not only more expensive, but just further out of reach of everyday people. And when rates start to rise like this, when it becomes 50% more expensive to borrow, for a mortgage in this case, especially as rates are continuing to rise, as we'll talk about later, anywhere 30 to 50% higher in this case for the interest that you're going to have to pay on the base principal, that sends shockwaves. And we see that reflected here. Actually, mortgage rates had to quickly adjust here. For the past month, we actually saw about a 1/5 point drop, and that's pretty dramatic to see that actually as we peaked out here, to see such a sharp correction, and as a response to the fact that less people are taking out applications. There was a big drop in November that led these rates to actually correcting as the 30-year mortgage rate had a pretty sharp correction to meet again with that lack of demand, because they need to make it less expensive. And then again, this is coming at a time where rates are increasing. So this means that banks' margins, or those who are giving out home mortgages, are starting to shrink. As we took a look at the financials chart there, it makes sense, right? If the banks are having to lower their rates for consumers, the margins of profit start to shrink because the Fed funds rate, the cost to borrow capital, the bank's cost to borrow capital from the central bank, is going up. And the profit that they're making from selling it, or the rate that they're giving here in the 30-year mortgage, is starting to dwindle. So again, you're getting that squeeze in the financial sector. And still, even with this, there's not a killer amount of demand that's coming in. So they might have to drop these rates even lower. Again, squeezing the financial system more and more. Now, I'm not saying that banks are having a hard time by any means, but this does set a strain on the growth that we've seen in financial markets, and could continue to have a lasting effect in this case. So I think we're going to see this continue to decline into the mid 4% range. And as the Fed is looking to raise the base rate to 3%, as we'll talk about later on in the video, it's starting to set up an interesting scenario. So as we've talked about some of these statistics, guys, it seems very doomsday-ish, right? We're obviously setting up for what looks to be a recession. Again, as we mentioned, it's well overdue. And it could drag out, in my opinion, I think, well into 2019 and 2020, and even into the earlier range of the 2020s. I think this is going to be a little bit of a longer-term slowdown. Now that I realize that, and I've made that point clear, why is it different than 2008? Why are we not going to probably see the sharp, dramatic correction that I think many of us have expected to potentially come into the real estate market, into the general credit market as well, and just overall the economy? Well, it really has to do with the difference in housing policies. Okay, so if you do some research and understand really what caused 2008, specifically the housing bubble, and that burst in 2008. It's important to understand that this was not something that was built under a few years. Again, as we talked about a little bit earlier, there was about a about 2-decade procedure where back in the 1990s and in the early 2000s, between actually a variety, I know people always like to get political with things, between both the Clinton and Bush administrations, there was massive programs where the government mandated ease of use policies for taking out mortgages. They literally, in a sense, whether banks lobbied for it or they just did it simply to boost up their their potential to get reelected as politicians. Who doesn't love giving away free stuff? Basically, through those two administrations, through about a 16-year window, eased the ability to get a mortgage. They lowered the standards. Not to mention as well, you had the debacle with the credit rating agencies that made junk bonds and people with terrible credit ratings were basically be able to be seen as AAA ratings. They were perfect mortgages that were most likely to be paid back, and really they weren't. So again, as I mentioned, you got these regulatory frameworks, for example, like the Ninja or Nina loans, no income, no asset loans, no problem, we'll still give you a loan, and a mix of that plus of the fact that the credit rating agencies were completely undermining the fact that a lot of these mortgages were not going to be able to be paid back. So this is really the major difference here. We do have the same fast rising of rates as we'll mention here. For example, the Fed funds rate is at a pretty rising at a pretty steady pace and is on its way to becoming around 50% higher than where it is now in 2019. There's different estimates as to where the Fed is going to raise rates to. Some are estimating the upper 2% range to 3%, sometimes around 3.25%. Doesn't matter. The rough estimate is around 3%, and that's going to be about 50% higher on the base rate here, which is either going to mean two things. The bank is making a lower profit margin and is getting squeezed, or B, the consumer is getting squeezed out of the potential to even take out a mortgage or be potentially financially solvent to pay back a mortgage. In this case, they might be able to take one out, but they most likely will not be paying it, and more mortgages aren't paid back. That dents the financial system. That thereby leads into a overall panic in markets and again, the creditworthiness of the consumer base. So in this case, the important thing to take away is that this isn't exactly like 2008. It's more like 1994. And in this article on Bloomberg, I think it was a really good opinion piece posted on Bloomberg. It talks about how, and again, I'll leave it linked down below if you guys would like to look through it, that basically speaking, we have very similar monetary policy. We have the rising of rates, as we mentioned before, and that squeeze on mortgage applications. As we can see here in December of 1993, the seasonally adjusted annual rate of new single-family home sales, as we discussed earlier, was at 812,000. A year later, in December 1994, it had fallen over 20% to 629,000. And this is obviously as rates go higher. It's not rocket science. But at this time, we didn't have all the ridiculous legislation that we got in the later part of the 90s and into the 2000s that made it easy for just about anyone to afford a mortgage. So in this case, again, it's a matter of regulatory policy. We still have a lot of the restrictions in financial markets on leverage that people can use in investing comparative to 2008, which were at levels unbelievable, 20, 30 times leverage for a lot of the financial banks to use in investing. But now that we have these regulations in place, it is much more difficult to get mortgages. I can tell you guys I've had many personal stories of people who want to get a mortgage, some of them even actually quite creditworthy, and they still can't get one. So in this case, this is why we're not seeing anything dramatically sharp outside of really the cities where, again, property values ballooned beyond measure because investment banks were just pouring money into it. And they got to levels where people can't afford or even rent out of them. So again, the story here is that we are setting up for a recession. It's just a matter of being a little bit distinct from 2008. This is a good chart here to put this in, as an example here. And I think to kind of put a close on our point here, that as we can see here, we have a ratio between aggregate household debt, generally the overall debt that someone holds in regards to their household, to an income, to their income in this case. It's a ratio. And we've been holding since 2013 below the 1.1 to 1 ratio here in regards to the aggregate household debt to income. And this is very much back on the longer term uptrend that we've seen since the 80s. We broke away here, for example, in the early 2000s and got up to a range around 1.2. 20% higher from where we are really now. Actually, more than that in this case, seeing as we're below a 1 to 1 ratio. So we're not at the ridiculous nature of people, again, just being able to take 2 or 3 mortgages out with terrible credit score in that case, or terrible financial solvency in this case. So it's something where we have to be fair. We have to step back and realize, okay, we can take a look at the data. We can see that this isn't exactly playing out like 2008, but we are in for a slowdown. And I'll go ahead and mention something here, guys, to really reflect it in a sense of price action to my point. A lot of people, I think, sorry, I'll do the actual index here so we can get a longer term price history. This is what we looked at was the ETF, the home builders ETF. This is the actual index that ETF tracks. We can see here that we topped out here in early 2018, as we've been talking about on the channel, at a level that was support back here for a longer term rally into the mid 2000s. The home builders were building much more homes. They were estimating much higher numbers, and they were getting much higher numbers of buyers because of the regulatory policies that were set in place. Again, when you set the standard so low that you don't need income and you don't need assets, and we'll still give you a mortgage, the American dream of having a home, that sets a precedent for a massive bubble to be built up, not to mention when rates were as low as they were at the time, comparative to, say, the 80s or 90s. So we're definitely not there. It looks like we're already setting up for a correction, a clear one back to some of the levels we saw back in 2012 to 2016 for the housing market. I think this is a range that we could see, and it's nothing panicky. It's not 2008 again. We didn't rise up that dramatically, but in this case, we are experiencing a clear recession. So in summary, what can you do with this, guys? What's the value that you can get out of this and all this rambling that I did in the video? I would say more than anything to expect a slowdown into 2019 and 2020. I'm not long many equities. I'm not long on, going out and buying a house. I'm waiting patiently. I'd actually like to go out and put a down payment on a house and things of that sort. I'm going to have to be thinking about that in the next, obviously, few years as I want to raise a family. But I would say to be patient in regards to, waiting for the housing market to correct. And again, I can't be your financial advisor, guys. You got to determine that for yourself. But at least I know, and I want to share with you all, that I'm waiting patiently on sitting down with a 30-year mortgage. I'm waiting patiently on equities for a nice range of evaluations that seem fit to me on some of the major indices and companies that I like. So for the time being, it's a matter of understanding that we are going from a risk-on to risk-off narrative in asset markets, and to just simply be patient. And look elsewhere. Where are some good areas that we can hedge? As you all know, I'm going heavy into commodities this year. Some of them not only in the hedging precious metals like gold and silver, but I'm also looking at markets like uranium in this case, and some of the uranium miners. There's a lot of different areas that you can focus in. And as I mentioned as well, still heavily exposed into cryptocurrencies. I think crypto will do well in 2019 as we start to get some more financial interest in it, not only obviously with awesome things like Backed, for example, but things like an ETF potentially coming at later down the road as well. So that's it for the video, guys. Hope you all liked it. Hope you liked it crunching through the numbers and the data. I know I like it. I'm a nerd like that. And hopefully you're a nerd just like me and you like doing that kind of stuff. But, at least we're smart nerds getting an idea of where things are and getting a good picture of where we are currently in the global economy and in regards to something as important as the housing market, which makes up well over, I think, a fifth of GDP. Very important. So anyways, that's it for the video, everyone. Thank you all so much for watching. As I stated before, I hope you all are having a wonderful weekend. And if there's any interesting points that I didn't mention in this video, whether they be bullish or bearish, put them in the comments down below. Get a discussion going, guys. We can only be as smart as the data that we share with one another and the library of knowledge that we've built up over the past few years. And love when you guys would be willing to share that with others and can help other people get a good assessment of where we are at the moment. Anyways, that's it for the video. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.